Okay, we are live. It is unusually for the Sunday show. It's Saturday still. Benny's going to AC/DC tomorrow in Madison. But hey, welcome to the Sunday show on a Saturday. Hi, Benny.
Well, technically, it's Sunday for you. So it
Yeah, it
is.
is.
You are actually
But
doing Sunday
I
show
live a
on a
lie.
Sunday.
I live a lie. I live a lie. I
You
record the
do.
Sunday show on
You
Monday morning.
do. You do. You do. Yeah. No. We're gonna do this. Rupert's a mensch for accommodating me to go to the AC/DC. Just a real quick reminder: follow us on Instagram. We're now on the Instagram, right, buddy? Like
We are on
we're
the Instagram
expanding our
and we're on
social
the
media
TikTok.
presence,
And we're on the TikTok.
and we're on
Our
the
secret.
TikTok. That's true.
So yeah, please follow us on the gram. We want more people to find the show. Listen, just as England crushed the third place playoff, and so fittingly, we're going to have a UK themed Sunday show. How about that? You want to start with the trains, Benny?
Yeah, let's go. So I published a paper this week that I had been sitting on for a little while. And I think everyone who's been listening to us knows, like, Rupert and I have been pretty deep into the neoclouds, into AI. And, I've been writing these essays about the historical parallels. And I think, everyone wants to like compare this thing to '08. And there's some parallels, like the credit thing there's some parallels, but the .com, there's some, but like, the 1840s British, since this is the British themed show, railway mania was the greatest capex boom ever. There's a couple of researchers that I have in the paper kind of saying that it got up to 7 or 8% of GDP in 1 year. And over the period of that decade, it was half of 1 year's GDP on one like build out. Now, look, the main thesis of the paper, if we go back to this, is basically here, or I don't know if I had it on there. Yeah, here, right here. That we can have AI be real. The railways were very real, right? Like they went and powered the Victorian Empire for 70, 100 years or longer. It's not like British is not in the G10 anymore, it's still a real economy. And so I'm a firm believer that LLM is going to be it's not going away. This isn't fake, but it's just that maybe the paper is in front of the capital, and the capital might be too high. And, if you go back to last week's episode, I kind of put that like on paper for people. This is just kind of
it's like so many infrastructure assets, from tunnels to satellites to bridges. The third owners of the equity do just fine. The first and second typically don't.
Yeah, and there's a great book that I would recommend all the readers to listen to, which is Technology, the Engine That Moves Markets. And I forget the name of the author, but he was a guy who worked at Franklin Templeton, big mutual fund in San Francisco. And he took a year hiatus back during the .com. And he has this book, he has newspaper clippings, and he shows how it's kind of the same thing, and in my paper, I talk about Kindleberger and Perez and, Minsky, and like, you see the same pattern. And this idea of a bubble, it is almost necessary. Like you need it because it attracts capital. We throw a bunch of spaghetti against the wall. We figure out what works. It busts. We consolidate, and then society benefits from it. That's just kind of the natural way of things, right, Rube?
Yeah, absolutely. So walk people through your CMSS score, because that's your terminology, right? Just go back to the previous slide.
So I have that. Basically, the first two essays I wrote, the first one was John Law versus Elon, kind of the layer on Rupert's work on the SpaceX IPO. And then the second one was the 1720 bubble, where I talked a lot about the passive role of that, passive flows amplification. So there's 8 dimensions that I scored against, because I was like, I need some way to monitor these things on an apples to apples basis, right? Because usually when we read these papers, oh, this was like this. The one thing I'm trying to do with these is say, hey, let's compare what the factors were that matter. And then let's also, like, every one of these, I'm going to give the argument on the other side, and I don't want to just be like, okay, this is the pieces that I'm lining up to make you think that. But like, let's say, what's the other argument, which I did in this last paper. But the CMSS, like, it's 56 cases since The tulip bubble was the first one that I included. And, it's across 8 dimensions. And then there's like 4 different academic, like the ergodicity, the Kindleberger-Minsky, the, basically these various things. And you can kind of see how did it play out, how much capital misallocation was, what was the transmission mechanism, what was the policy response, because these things have a lot of dimensions to them. It's not just, prices got crazy. It's like, how did they respond? How fast did it go through? Like, what was the ergodicity of, like, how much ruin was there as a result of it, right? And so I'm trying to, look, again, I'm trying to give some kind of way of comparing these things over time. And it's obviously not perfect, but, let's just go back to this for a second. And I think that what we can look at, since we had Amish on the podcast in late May or early June, when we kind of said, okay, like the neoclouds are shorts, like without do your own financial advice. Like that's what we were trying to tell you. And, they're down 50%. Oracle's down 50% and got downgraded last week. Like we're trying to give you this is what's happening. So it's interesting because we've had a pretty good correction. Like what's the cost be down since early June or mid-June? Like 30, 25, 30, yeah. Something like that. Micron's done 30. So this chart right here shows you the concentration, because everybody's talked about the Mag 7 percentage of the S&P, right? And you saw here 1845 that peaked well before peak CapEx. So we're thinking about it right now, right? And I think this is a key chart to think about. Micron's down 30%. I think it's pretty much everyone's banking in 2027 earnings are going to be good. So what we're really trading on, because if you look at that, that's 2 years. We're really trading on 2028 earnings now, right? And in this case, it'll be 1848. And the market is a discounting mechanism that moves, it looks forward, right? It doesn't say, okay, well, this is what the earnings are today. And, so it's like thinking when is this going to change, essentially?
I guess the question for me is, in a much more financialized world, right? And given that this CapEx is, it is voluntary, right? And the world is more financialized. 2 years was a long time for the builders to go no mas, right? 2 years of terrible stocks, right? And they were still building. What does it have? What's the flex this time? What's the catalyst to stop the build?
Well, I guess it would be the capital markets, right? I think as we've talked about, right? Like Oracle getting downgraded, Oracle's debt trading basically at junk. SpaceX almost it's damn near junk now. It's 160 CDS, right? And it opened at 110. I think it's, you remember Rupert last September when I came back and I was like, yo, it's time. Like the market's about to switch on these guys. These guys are going to do debt funded CapEx, and the market's going to re-rate them down, and Meta and Microsoft and the whole hyperscalers. And honestly, let me show you this chart because I think this is kind of indicative of that. Here we go. When the general idea is in the height of the bull, the market is going to reward CapEx because it's seeing better returns, right? So it's like, put more money.
We've seen that phase, but we've seen that phase over the past 2 years. Right.
And this chart shows you that clearly September 25 was the top, right? And so, not only was that Bitcoin's peak and Oklo and SMR, and I can just name a whole bunch of fake bullshit stocks, but if you look at the black line on the bottom, so the left is a 5-year chart, and the black is the UBS hyperscaler index divided by the S&P, the relative, right? Up and to the right until September, right around the time I said that. And since then, down to the right. And then the one on the right is just the performance since September. And so, recently, I think we talked about it in early June. It was hyperscalers really had gotten dunked on. Maybe it was time to buy a little hyperscaler against some of this stuff. But that's just a relative value trade. But the whole point is that the market is not interested in this because they're not convinced about the AI ROI, as we talked about last week, right? And so, when we get to a point where the market's punishing them enough, I think that's it. And we're starting to see more and more signs of it, right? Our SpaceX is now $10 below deal. Yeah, buddy. The Meta is now a neocloud or entering the neocloud business like SpaceX. You had a ton of supply, which is a sign. In my paper, I talk about that. I show like the number of railroad equities at the peak was 220, 225 different stocks. And 2 years later or 3 years later, it was 60, right? So you had a 70-some% culling in the number of railway equities out there. And it's no different than like right now. It's different. It's different in the sense that we had a bunch of small ones, kind of like how the .com was. A lot of different, like now we're just concentrated in it, right? Like it's the big dogs basically. But like it's the same in terms of aggregate supply coming online, dynamic. And then you see like, the credit market is just, it's starting to show you like, spreads are widening. There's more CDS being floated. I mean, the CDS market is becoming a real market again. It's been a long time since CDS was a market that was like it was something that was in play, right? Now, I saw a chart this weekend that showed IG issuance to U.S. Sovereign issuance, and that's now dominating sovereign issuance. And that's like a wild new dynamic that we haven't seen since pre-GFC, basically, right?
Real crowding out. It's real crowding out.
Yeah. So you basically have the government and the AI trade taking up all the credit capital and, equity capital. And that's why, I mean, look, honestly, I was talking to a buddy earlier, and if you were thinking about like, what do I want to own versus like, if you want to short the picks and shovels or the hyperscalers pick and shovel, like some kind of combo, like, owning the stuff that has not been owned, the staples, the regulated UTs, bond-like securities, maybe even just bonds themselves, like versus a short book of that, like that could do well because, if people just reallocate, like Mike Green talked about with us, like why you had the small cap banks and small cap value just absolutely rip in 2020 or 2001, 2002, 2003, 2004 is because some of the money is just too crowded in one area. And that's why I showed this chart. If we go back, right here, the concentration. I mean, the railway mania was the all-timer in terms of concentration. And, depending on which one you chose, because there's different railway indices, 63 to 70% of the market in 1840 Victorian, London Stock Exchange era was railway, and if you put Meg 7 plus semis, plus some of these picks and shovels, we're probably well above that 40. But you look at Japan, Nifty 50, .com, that 40% level from a concentration point of view is kind of where these things peak out, right?
Yeah, I mean, I've got this issue with the staples generally, in that some of them are just so crazy expensive. The Walmart, Costco's, the Cokes, the Pepsis of this world. I mean, what I like and what's really working since we talked about it, 4 weeks ago, is just own the equal weight against the.
Yeah, it's been a good trade for you,
right? It's
the same concept, right?
Like very similar concept, but without going into. I mean, it's tough to contemplate the forward returns owning staples at multiples of sales that just it's going to make very hard to deliver IRR.
Totally understand that, right? Like the staples are dominated by Cisco and Walmart, and I mean, let's Cisco, Costco, sorry, similar. But like Costco's stock hasn't done much for 2 years, year and a half now. Like that's been a just treading water stock, and that, I think that's to your point, like. They could relatively outperform, but not actually do well necessarily because they're already full. You know what I mean? So, yeah, I'm not necessarily saying staples as it's a no-brainer, more as like it's healthcare. Look, I think biotech is, and I'm not a biotech guy, but
neither am I.
and I talked to my buddy David Maris, who's a partner at Wall Street Beats with me, who's like number one II pharma analyst forever. He likes Eli Lilly. Eli Lilly has 150 years of data. Like, I think drug discovery, like, again, a tourist novice saying this, so like I just don't want like this to be taken, but it makes sense to me that like data is the value now because the computation and the output is not worth hardly anything anymore. And so, you know, they're also sensitive to rates. So if this rolls over and it's all funded, like the private credit's all funded by SOFR, you can see a world where they got to take rates down because this is a problem, right? So rates come down, biotech, healthcare, maybe that's the better space than staples. But I guess what I'm trying to say is those areas, if you did healthcare divided by S&P, like their share of the total is dramatically lower. Staples is dramatically lower, and regulated UTs is even lower. I mean, there's even a trade within regulated UTs of a correlation break with the XLK or the NASDAQ or whatever you want to say. So you could get.
The thing to watch is you've actually got to put together a basket. You cannot buy the XLU because they've got all of the IPPs in there, and that's
you want to not have the IPPs. I agree. Like you want to have the regulated UTs in there, and then those are like the back. So you have to have like a defined basket, but like there could be a correlation break between them because they've traded with tech, and so there is something that I'm looking at that's interesting and involved. Maybe I'll talk about it more later, but like the general idea is that it's not necessarily that this ends up in like an 08, like everything gets dumped. It could be like just a massive rotation type of situation as well. You know, like, yeah, the credit, like the area that's gotten all the capital where they're selling all the supply. I mean, look, I'm not saying anything people don't know. I mean, this SpaceX down 40% since a couple of days after the IPO.
From the Icarus print, yeah.
And
I mean, it's still only $10 below IPO price, the actual price,
which we both thought was too high to begin with. So yeah, I mean, but like SpaceX, Oracle, CoreWeave, Nebius. I mean, Nebius comes out last week and says they're going to be consultants. They're going to do the Trump move, right? They're like, well, this capital heavy, real estate, we might not want to do this. You do what Trump did. He said, I'm just going to license my name rather than run casinos and build real estate. And that should tell you something in itself, right? Like Meta and SpaceX becoming neoclouds, a neocloud saying, hey, we're going to be an asset light neocloud. Like, yeah, I think like, and the other thing that happened last week was the Kimi K3 model comes out. And that just is another thing that we've harped upon on the show is that these LLMs, the frontier models, their moats are just not very wide, and it comes out that Fable's now going to be included in subscription plans, surprisingly, right? Like, and so, the reality is selling a commodity that is capital heavy and you're burning money is a tough business. Ultimately the last thing I'll take away with the thesis is that back then, they talked about how much track would be laid, and there's two dynamics here. One was there was a bunch of insider dealing, right? So every time you got a track laid, you had to have an act of parliament to pass it. But these guys in parliament were in on it, right? So they were passing their favored that they were long, and the Foreign Policy Journal comes out with a paper recently that shows 56% of trades by DC politicians are on stocks that they're voting on the bill within 6 months. You know what I mean? So, and don't get me started on Trump and his insider trading shenanigans. So you have that, and that could be something that keeps this going longer, right? Like, oh, we're going to back up OpenAI, or we're going to keep this going because that's been the growth engine, which growth helps politicians stay in office because when things are fine, people don't vote people out. They vote people out when they're pissed. And then the other thing is basically that can these guys earn their cost of capital? And, we definitively have shown that CoreWeave cannot. And I'm not sure about all these other guys can. And if credit spreads widen, cost of capital is going to go up until the Fed finally, finds Jesus. And, we talked about it with Dredge on the show last Thursday that Warsh, like many guys, like Bernanke, like Powell's coming out and trying to establish credibility. And let's be honest, inflation's too high right now. So, it's not like it's a crazy stance because inflation is too high. So yeah, like what the slide that Rupert just put was like, you know, kind of the takeaway, and basically the technology can be real. No, I was putting that up for you, and then we're gonna move on. The technology can be real, but the capital can still get smoked. Basically, that's the bottom line. Go read the essay. It's on Substack at Capital Misallocation.
Absolutely. So listen, we got diverted a little bit away from the UK, but we're coming back there firmly. Do you know who Camp Binface is?
I don't. Tell me.
Okay. So essentially, we've got an interesting by-election coming up in the UK where Nigel Farage, Mr. Brexit, resigned from his own seat to stand again. And no other major British parties are standing against him in his seat. So it's all become a rather embarrassing publicity stunt. And his biggest competition in this by-election is this character Count Binface. And you know, this is a long tradition in British politics around having kind of joke candidates in special elections. It's just normally they are on the fringe of the event while the main parties duke it out. But we've got this by-election coming up in August where you know, I don't think it's realistic, but I do think that Farage will reclaim his seat. But you know, I think we could be at a kind of peak populism moment in the UK, which is interesting timing wise, as the UK gets its 7th prime minister in as many years coming Monday, with Andy Burnham being sort of crowned unopposed into the seat. But you know, we are in a stage of kind of a maximum hate on UK assets right now. This is the latest BAML fund manager survey. We're looking at sort of 38% underweights in UK equities across their survey, which is, you know, bang in line
GFC
with
lows,
GFC and obviously post-Brexit lows, right? June 2016, we're on our 10th anniversary of Brexit this year. And that you've got maximum shorts in sterling CME futures right now, and that trade isn't really working. What's interesting, if you look at the pound on a trade weighted basis, right? Ignore the key cross rates, but look at it on a trade weighted basis. Sterling looks like it's trying to break out. Yet you've got gilt yields, you know, sitting at the top of the yield leaderboard in the G10. You got maximum hate on. You know, there's no doubt that the bond market is gonna put an early test on Burnham and his Treasury team. You know, but in absolute and relative to Treasuries, gilt yields are, you know, higher than where they were with the sort of Liz Truss lettuce moment back in September 2022. And then if you look at where UK equities are on a CAPE adjusted P ratio, now this is going back to the year I was born, right? There's never been such a delta between the valuation of US and UK equities. They're sort of universally hated, right now. Now I've had a position that's been treading water really for the last 12 months in these small and mid-cap closed-end funds listed in London. They're called investment trusts there. I sort of made the case for re-underwriting and potentially adding to that position in my weekend note, which came out your time last night. You know, if you look at what's going on in the UK right now, I mean, the UK equity market's getting hollowed out by M&A, right? We had another deal, a big industrial firm called Rotork that got acquired by the Swiss, by ABB on Friday, or that was announced on Friday. You know, big names, you know, Intertek, Segro, the big data center builder, Schroders, the asset manager, even EasyJet's getting, and private equity buying airlines. Jesus. Well, anyway, the market's getting hollowed out by private equity right now. And I really think that, it's do or die time in terms of restructuring the UK economy. And we started to touch on this with Dredge on Thursday. UK pension funds currently only have a roughly 5% position in domestic equities, right? Versus
that's incredible.
Versus north of 20 in US equities, right? It is, I think we're going to see, I'm apologies in advance to all of the libertarians, no pearl clutching, please, but we're going to see some interventionist sort of state capitalism type activity. And, capital in a multipolar world, capital is strategic, right? And, we're going to see, just as we've been seeing suggestions of in Japan with Katayama's announcement last week, just as we saw with the tax holidays that the Koreans were giving to savers that were repatriating US security holdings. I think we're going to see that kind of flavor in the UK too. You don't have to love it; you just have to expect it. Accept it as a potential reality. And I think there's a trade alongside. Now, as I mentioned before, this is not about grabbing the MSCI UK, right? Old Prof. Damodaran did his equity risk premium piece last week, which is always a really good read. If you're buying the UK, you're really only buying a 20% exposure to the UK economy, because you've got all of these huge energy companies, global miners, global healthcare stocks. No, I'm not saying that I've got a problem with that kind of beta at all, but that's not the trade if you want to buy the bin-faced bottom in UK risk assets. You need to buy the mid caps, and I like to do it via these actively managed investment trusts, which have the benefit of the NAV discounts can be quite volatile. At the moment, they're kind of mid-range right now relative to long-run history. The reason I like this is sort of several-fold, in that these things do trade at a discount to NAV. There's a lot of M&A activity. It's usually these guys' top holdings that are getting taken out at a premium. You need to add that. You need to add that discount on, right, into your sort of contemplation of returns. And this sort of gets us back to sort of broader macro risk. The time to buy these closed-end funds is when we have a sort of deleveraging event in markets. Now, if you think there's a decent chance with a bond market scare or gilts market scare, if we think we have a sort of classic summer sort of correlation to one deleveraging moment like we had 2 summers ago, implied correlations are on their arse again. The brush is set, as we discussed with Dave on Thursday. That would be the time to hold your nose and capture an extra 300 to 400 basis points of NAV discount to get an entry into this trade. So I'm already in, but my inclination is to double up if we get some kind of discount widening risk event.
Yeah, and it's interesting because I was talking about staples and Utes, but you could say Chinese equities, you could say UK equities, you could say a lot of obviously not Korean equities, but again, it's kind of like, I think the takeaway here is, to your point, is buying the easy thing. Like, okay, I'm going to buy the MSCI, maybe not the right move. Buying the XLU, maybe not the right move. You need to go a little deeper and actually do a little work in basket construction. Hey, what areas do I want to own of emerging markets? Like Latin America looks good. Korea doesn't look that good. You know what I mean? Yeah. It's just, I think there's something to be said that even within the microcosm that is the UK, which I think there's probably something to, and not really emerging market, although maybe more emerging than British people would like to think. Yeah, it's a little zinger to the squirrel. But he's saying mid cap. I think there's value in like really thinking through the way to play a theme versus the easy way. Because even the IWM is very AI heavy. So you're like, hey, I want to own this other stuff. Well, that is not necessarily the way to do it. And so I think that there's something to that. And maybe we should start an ETF if those DRAM guys can go from putting 250K into running 25 yards. Maybe we could find a couple intelligent ways to get people on it.
I'm afraid the value and dividend and low beta factor is not the one that typically attracts manias, right? Which is probably why it's a decent place to hide if we're going to get this big rotation. Anyway, listen, let's wrap it there. This is going to go live probably at the same time as the World Cup final, so the non-Argentina Spain watchers can tuck in then. We have got the macro tourist himself, Kevin Muir, rejoining us on Thursday. He's been writing some really interesting stuff recently, so tune in for that. Anyway, a Saturday version of the Sunday show. It's still Unmissable, obviously. Follow us on the Instagram. Follow us on the Instagram.
The Unmissable Sunday in Australia show. That's what it was today.
Exactly, the first Sunday in Australia show. I've got to go to Costco. Anyway, Benny and the Squirrel are out.